Welcome back to Banking 101, a first principles jargon-free course on banking. Please click on next icon to begin this lesson. In the previous lesson we covered consumer banking. In this lesson we will learn about wholesale banking products, which are designed for and sold to businesses. So let us get started. Let us take a moment to orient ourselves on where we are in this course. We are currently in the process of learning about 4 categories of products sold by banks. This lesson is focused on wholesale banking. Wholesale banking products are financial products sold to businesses, which could range from a micro business like the dry cleaner down the street to a Fortune 500 company. Banks segment businesses into the annual revenues earned by that business, and the cutoff amounts to drive this segmentation varies by banks and country. We can think of businesses as part of a pyramid, at the bottom of which are sole proprietors. These are freelancers like accountants and personal trainers, who have set themselves up as legal entities. They don't have any employees. Segment B are micro enterprises like dry cleaners and florists with very few employees. Segment C are bigger than micro enterprises but still very small.
Typically, segments A, B and C are served by the branch network of the bank, along with digital channels.
Segment D consists of medium enterprises.
In the U.S., the term small business collectively refers to segments A, B and C, while segment D is called business banking.
The term commercial banking is commonly used to refer to banking services for the next segment, segment E. Finally, at the top of the pyramid are the largest companies. Banking services to segment F is often referred as corporate banking, to distinguish from commercial banking. In some countries, segment F is further bifurcated into corporate customers and the largest institutional customers. There are some fundamental differences between wholesale and consumer banking products. First, the product mix in wholesale is wider. For example, a bank may be responsible for paying salaries to the employees of a business, a service that does not have a counterpart in consumer. Second, even if the underlying product is the same as in consumer banking, the products are delivered with more customization. To take a trivial example, as consumers, we can either have a single user or a joint account. For a company, on the other hand, a bank account may have complex account empowerments associated with employees. Third, though banks face regulation at the entity level, consumer banking is often subject to additional regulations that are not applicable to business customers. For instance, anti-discrimination regulations apply to consumer lending only. Finally, customer acquisition in consumer banking is distribution-driven. The distribution may be physical in the form of a branch network or digital in the form of marketing campaigns. Wholesale banking is more relationship-driven, where the bank relies on a sales force to pursue business customers. As we move up in the pyramid of businesses, the difference between wholesale and consumer banking becomes more pronounced. Like their consumer banking brethren, wholesale banking products can also be grouped into 2 categories. Cash management products allow businesses to park surplus cash, receive cash from customers and pay suppliers. Credit products are loans given to businesses by banks. The rest of this lesson is a deeper dive into these 2 categories. In consumer banking we learned about the 2 core cash management products of bank accounts and payments. The same products are needed by businesses too. Banks offer 2 additional products to businesses. These are liquidity management and receivables management. We will learn more about them as we proceed through this lesson. The foundational cash management product is the bank account itself. The other 3 can be seen as add-on products on the bank account, kind of like apps on our smartphone. Payments is the ability to make outbound payments from and receive payments into these bank accounts. Liquidity management products help businesses ensure that the resulting net cash positions in their bank account are managed effectively. It means helping businesses have the right amount of cash at the right time at the right location and maximize returns on surplus cash. If we look at bank accounts, payments and liquidity management from the point of view incoming payments, these products are activated after the bank receives payments from its customer's customer. But imagine a scenario where customers of the bank's customers mail checks by post since the bank does not have a local branch. In this scenario, the business customer of the bank will not be receiving cash on time. Receivables management products are solutions that are designed to accelerate the velocity with which cash is received by a bank's customers. They sit between the customer and the customer's customer. Next, we will learn more about each one of these 4 categories of cash management products. Business bank accounts are similar to consumer bank accounts, but they are held in the name of a legal entity. Like its consumer counterparts, business bank accounts can also be either demand deposits or time deposits. An additional type of bank account we see in the commercial world is a merchant account that allows businesses to accept credit card payments. Credit card payments are received in the merchant account, from which, the funds are then transferred to the regular bank account of the business. Banks that provide these accounts are called acquiring banks. Not all banks engaged in the merchant acquiring business. We will learn more about this in our lesson on payments. In the lesson on consumer banking, we had defined the payments product as service offered by banks that allows its customers to securely transfer value from a source bank account to another bank account and vice versa. The payments product remains the same whether the customer is an individual or a business customer. Just as consumers access the payments product through various means like checks, cards, and portals, so do businesses. For instance, when an employee pays for an expense using a business credit card, the payment is made by the credit card issuer just as a personal credit card. But the liability to repay the credit card issuer is with the business and not the individual. We will discuss payments as a banking product in detail in the next lesson. While payment products enable transactions flow in and out of bank accounts, liquidity management products help businesses utilize the resulting net cash positions more effectively. To understand liquidity management, consider how we optimize between two objectives. One is having sufficient cash in our operating account to pay for our daily expenses like rent and food. But cash in our operating account earns very little interest. Hence, to earn a higher rate, we would need to place a part of our surplus in investments that yield higher return, but we have to hold that investment for a longer period. The treasurer of a business performs the same balancing act. But her job is made more difficult by the greater number of inflows and outflows hitting a business bank account as compared with a personal bank account. We will cover two examples of liquidity management products in this lesson: sweeps and notional pools. Consider the scenario of a business that has multiple bank accounts across divisions and geographies. The treasurer of the business may want to centralize the cash in a few bank accounts. Sweeps allow businesses to centralize their cash into fewer accounts. Businesses often consolidate surplus cash from multiple accounts into destination accounts, which earn higher yields. A sweep structure can automate move of surplus cash into centralized accounts based on predefined rules. The bank can set rules that if an account falls below a threshold balance, it will get automatically replenished from another account, thus minimizing overdraft fees for its business customer. Another example of a liquidity management product is a notional pool. Through this product, a bank can offer to consider a set of bank accounts as a single notional bank account, so that any overdraft balances in one account are offset by credit balances on another. As long as the business has sufficient cash in this notional pool, it avoids overdraft charges. This is obviously convenient to the business treasurer. But this also benefits the bank. When a business has an overdrawn bank account, effectively the bank is lending to the business. In a notional pool, the bank effectively has the contractual right to dip into the surplus accounts to fund the deficit bank accounts. This effectively reduces the bank's risk. We will now turn to receivables management products. Before we go further, let us identify the three tiers of entities that are involved in cash management products. First we have the bank, then we have the bank's customer, and finally the customer's customer. The third level does not exist in consumer banking. For convenience, we will use the term buyer to refer to the customer's customer. Bank accounts, liquidity management, and payment products primarily touch the first two tiers. Receivables management requires a much deeper integration with the third tier. For illustrating receivables management products, we will refer to a fictional company called Oscorp, which is the customer of the bank. Oscorp is a chemical manufacturer that sells chemicals to other manufacturers. Receivables management products are best understood in the context of the order-to-cash cycle of Oscorp. The order-to-cash cycle refers to the steps by which Oscorp converts buyer orders to cash. Before the cycle even begins, Oscorp must plan its bank account structure. Oscorp is expanding into Europe, where most of revenues will be derived from 20 large customers. Should Oscorp open bank accounts in each country to receive payments? Should it open separate bank accounts to receive cash from each of its top enterprise customers? These are the type of questions that a bank can help Oscorp answer. After the account structure is set up, a purchase order is raised by Oscorp's customer. We will use the term buyer to refer to Oscorp's customers. Oscorp fulfills the purchase order by shipping goods and raises an invoice on the buyer. The buyer then initiates payments. The buyer may write a check or initiate payments electronically. Oscorp's bank receives a payment received notification from the buyer's bank and credits the payment into Oscorp's bank account. Oscorp then reconciles the payments received with the invoices that were raised. Post this reconciliation, Oscorp chases past due buyers for funds. The goal of receivable management products is to reduce the duration of the order-to-cash cycle by accelerating sub-steps within the bank's sphere of influence. Receivables management products belong to 3 different steps of the value stream. The first stage is invoicing, where Oscorp invoices buyers. The next stage is collections, where Oscorp collects payments from buyers. The third stage is reconciliation, where Oscorp reconciles outstanding invoices with payments. An example of a receivables management product at the invoicing stage is an electronic invoice presentment and payment solution, abbreviated as EIPP. While this sounds like a mouthful, the solution simply allows our fictional company Oscorp to electronically invoice its customers. Oscorp's customers, the buyers, can access invoices on a website, and if they consent to pay, the bank debits their bank account. Banks may offer an EIPP solution through a third party or have its own proprietary system. Alternatively, Oscorp may not be interested in getting an EIPP solution from its bank. As we move to the right, at the collect stage, an example of a product offered by banks is Lockbox. Say the bank's customer is an electric utility. The customers of the utility company are asked to mail checks to a post office box, or a PO box, located in the same city. For banks that don't have many branches, this is an efficient substitute for its customers. This PO box, also called the lockbox, is located in a central location from where the bank picks up the mail several times a day. The bank then scans the checks and remittance slips, providing the utility company with a digital data feed. Finally, the bank presents the checks to the banks of the check writers. The lockbox service, thus, accelerates the speed with which a business receives funds, as well as provides the customer with faster visibility into who is delinquent. The example illustrates the difference between payments and receivables management products. In a pure payments product, the utility company would collect the checks and mail to the bank. The bank would get involved only from the point checks are deposited. In the reconciliation stage, a major issue faced by large businesses is to reconcile payments received from customers versus invoices raised on them. A business may get thousands of payments from their customers in a single bank account. This makes it difficult to identify who is sending which payment. An example of a product that addresses the cash commingling problem are virtual accounts. Opening separate bank accounts to segregate cash from different buyers is onerous. Instead, the bank can issue multiple virtual accounts that are mapped to the parent account. The buyers can reference the virtual bank account when sending their payments, so that the payments are routed to the virtual account specific to them. Improved visibility to who is not paid helps the bank's customer to accelerate the velocity with which it receives cash. At this point, we have completed the overview on cash management products and we are ready to move on to credit products. Credit products refers to banks lending to businesses. Credit products can be grouped into 5 big categories. These are commercial real estate loans, commercial and industrial loans, leasing, commercial credit cards, and trade finance. We will next take a look at each of these categories. Commercial real estate loans, abbreviated as CRE loans, are loans taken to finance the purchase of real estate that is meant to be used for business purposes. Such loans could finance acquisition of land, construction, or purchase of a finished property like a hotel. CRE loans may not always be large. For instance, it could be a loan to a small-time landlord who owns and rents a handful of properties. The property being financed serves as collateral for the loan. When evaluating whether to grant the loan or not, the lender not only looks at the creditworthiness of the borrower but also the income-generating capacity of the property. For example, when financing a mall, a lender may think that the mall owner will struggle to find tenants as online shopping grows. Commercial and industrial loans, abbreviated as C&I loans, are business loans made to finance daily operations of a business as well as one-time capital expenditures. C&I loans can be secured by collateral or can be unsecured. For a secured loan, the collateral could be tangible like a physical equipment, or it could be intangible, like invoices that are yet to be paid by the borrower's customers. In either case, if the borrower defaults, the lender can seize the collateral to pay down the loan. For a secured C&I loan, the collateral could also be real estate. The similarity with a CRE loan is that the property is serving as collateral for the loan, but the difference is that the proceeds of the loan are not financing the property purchase. The underwriting is based on borrower attributes, but if collateralized, there is greater emphasis of assessing collateral quality. A lease is a specific form of financing a physical asset, which could range from a photocopier to an aircraft. In a lease, the lender is called the lessor and the borrower is called the lessee. The lessor retains ownership of the asset and the lessee pays rent for the usage of the asset. The assets can be movable like a truck or immovable like a heavy machine. Lease payments were historically charged as fixed amounts per month. But now technology is enabling new modes of repayment that are usage-based. For instance, the borrower could pay based on how many miles a truck drove, versus a fixed monthly payment. One unique factor that affects the underwriting of a lease is the residual value of the financed asset at the end of the lease period. This is the price at which the asset can be sold in the second-hand market. If a company leased an aircraft where the purchase price is $2 million and the estimated residual value at the end of term is $1 million, the lessor is effectively financing $1 million. This is an important negotiating point between the lessor and the lessee, with a higher residual value to the borrower's advantage. For certain asset types, the lessor may need specialized capabilities to maximize the value of assets that are returned at the end of lease. For instance, leased aircrafts can't simply be sold on eBay at the end of lease. Commercial or business credit cards are used by business owners and employees to pay for business expenses like travel or purchasing office supplies. Just as we discussed in consumer, credit cards are both a payment mechanism and a vehicle for borrowing. Clients could range from large corporates with employees spread across the world to small businesses. Unlike a consumer credit card, the credit exposure is to the business instead of the employee. However, for startups and smaller business, the corporate card issuer often seeks personal guarantee from the owner. Card issuers also need to provide platforms that can help their clients onboard new employees and offboard departing employees without friction. Trade finance is a highly specialized product category within wholesale credit. To understand trade finance, we will go back to the order-to-cash cycle of a business. Consider an automobile manufacturer that takes 15 days to assemble a car. The manufacturer then sells to a car dealer. The dealer pays the manufacturer 10 days after the sale. Finally, the dealer keeps the car in his showroom for 5 days, after which he sells to a consumer. The credit requirements of the manufacturer for the first 15 days is addressed by a C&I loan. Trade finance comes in at the point the manufacturer sells. From day 15 to day 25, the manufacturer needs financing as the dealer won't pay till day 25. From day 25 to day 30, the dealer needs financing. On day 25, the manufacturer gets paid out, and on day 30, the dealer gets paid out. Trade finance is the financing of the flow of goods or services from first sale to the final sale to an end buyer. In our example, it is the financing between day 15 and day 30. After day 30, a consumer auto loan finances the end consumer and the dealer can pay down its own borrowing. We can look at the difference between trade finance and C&I loans another way. Consider a seller and a buyer. The transaction between them is documented in some electronic or paper form. It could be an invoice, a purchase order, a bill of lading, or another document. Trade finance involves financing the transaction on the basis of what is documented about the transaction. If the lender sees an invoice that will get paid in 30 days, the lender may be willing to make a loan for those 30 days. Trade finance can be seller-focused or buyer-focused. In the previous example, lending to the manufacturer against invoices raised on dealers was seller-focused. Lending to the dealer based on the same invoices was buyer-focused. There are activities that a seller and the buyer performs outside the life cycle of that transaction, like manufacturing, marketing, R&D. C&I loans are thus not tied to financing of transactional activity. We can now define the point of difference between C&I loans and trade finance. C&I loans finance daily operational requirements or capital expenditures. They are not tied to specific sales transactions. Trade finance products finance the credit requirements related to specific sale transactions as documented in a paper or electronic record. In our previous example, the manufacturer and dealer could choose not to finance the credit gap associated with the transaction through a trade finance product but take a C&I loan instead. A trade finance product imposes more reporting requirements on the borrower. But in return, they get a lower interest rate from the lender because the lender is taking a much narrower risk. Trade finance can be used to finance a domestic transaction or a cross-border transaction. We have defined trade finance broadly as financing the flow of goods or services from first sale to the final sale to an end buyer. Hence, in our example, financing the dealer was considered part of trade finance. Often, the term trade finance is used in a more narrow sense to refer to cross-border transactions only. Within trade finance, a product that most commonly gets mentioned is a letter of credit, abbreviated as LC. We will conclude the discussion on trade finance with a simple illustration of an LC. Consider an exporter in Canada who is selling to an importer in Netherlands. The Canadian exporter does not want to ship goods unless he is sure that the importer can pay. The importer does not want to pay till the exporter ships goods. In a cross-border transaction, Buyers and sellers often don't know each other well. So a Netherlands-based bank comes in and issues an LC with the Canadian exporter as a beneficiary. The bank guarantees that it will pay the beneficiary. The exporter does not trust the importer but recognizes the LC issuing bank as a trustworthy entity and the transaction goes through. We are now at the end of the topic of wholesale credit. This is a vast topic and there are a large number of sub-products within it. The reason for the diversity of credit products is that the needs of businesses are very varied. A deeper dive discussion on the different wholesale credit products is outside the scope of this foundational lesson on wholesale banking. For now, it is sufficient for us to acknowledge the vastness of this topic. This brings us to the end of this lesson. In this lesson, we covered both cash management and credit side of wholesale banking. This brings us to the end of this lesson. So far we have covered consumer and wholesale banking, which together constitute 80% of global banking revenues. The remaining 20% of banking revenues relates to asset management and investment banking products. We will cover these in detail in the forthcoming lessons. In the meanwhile, review the summing up section of this lesson.